Hello everybody, welcome. This is chapter 8 of the TSR Mastermind. A very important chapter, to say the least. We will be talking about how the weekly candle forms. Every single Sunday inside of this group, I release a weekly analysis report. This weekly analysis report is meant to determine how the weekly candle will form. One of the most important job as an analyst, not a trader, but an analyst, is to understand how specific candlesticks form and to also have the understanding that all candlesticks are relative. Whether that candlestick is coming from a 1 hour, 4 hour, 1 minute, weekly, daily, monthly, yearly time frame, it does not matter. That means a daily candle forms the same way that a weekly candle does. An hourly candle forms the same way that a daily candle does, etc., etc. Now, you must also understand that this is a very important topic because it will help you determine your weekly bias and your weekly narrative. Very important, crucial. So understanding the candle. Firstly, before talking about candlesticks, I need to remind you that there's only two types of ranges in the markets. There's only two: a timed range and a price range. Within these two categories, there are subcategories. Timed ranges. What is a form of a timed range? Well, exactly what we are learning, CRT, candle range theory. That is a timed range. What is a price range? A dealing range is a price range. Why? Because that range high and range low was solely based on price action alone. What happened in price action? For a dealing range, we took out sell side liquidity and we took out buy side liquidity. That forms the dealing range solely based on price, a price range. A timed range is a CRT, 4-hour candlestick, closed after 4 hours, a specific 4-hour candle, draw the high and low. That is a timed range. What is the time? 4 hours. All right. Some more timed ranges could be kill zones, right? So we have the Asia session kill zone, we have the London open kill zone, and we have the New York open kill zone as well, all of which are timed ranges. There's a specific time that the kill zone starts and a specific time that the kill zone ends. Same thing goes with sessions. New York session, Asia session, London session, etc. A price range can be viewed as a dealing range, like I just explained. Also an expansion leg. So instead of price taking out buy side and sell side liquidity, we only take out one liquidity and we expand up as we start retracing downwards. That leg up is called an expansion leg, etc. Right? Every candle on your chart is a range, a timed range in specific. This means that you can either divide each candlestick into different phases, or without having a full understanding of market profiles, only focusing on the power of three, anticipate the open high low close. Two options. This is a daily candlestick. We have the open, the low, the high, and the close. Represented on the right side is the lower time frame, So higher time frame, we have a full candle. Lower time frame, we have the market profiles. This is a timed range, the range high and the range low. A timed range, a candle. Within the timed range, we have a price range. What is the price range? Right here, we took out buy side liquidity and we took out sell side liquidity. This forms a dealing range. Price expanded through the dealing range due to other factors. However, this is a price range. All right. This is a timed range. This is a price range. Now, just looking very quickly at this price range, what do you notice on the daily time frame? We have consolidation, ranging market, manipulation into likely a key level, taking out liquidity, right? Taking out liquidity and reversing higher. We have a range. This is the power of 3 right in front of you. A range, manipulation, expansion. As simple as it gets. Sometimes it's not as clear as this. All right, different ways that a candlestick forms. So before we move into understanding the weekly candle, you must first understand the way a candle forms and the 6 different ways that a candle forms. Why is this important? Because candles are fractal in nature. Same thing with time, right? Anything that works on a daily time frame will work on the 1 hour time frame. What does this mean? A fair value gap will work on the daily time frame just as much as a fair value gap will work on the 1 hour time frame. This means time is fractal. Now, I'm telling you, candlesticks are fractal. There's only 6 ways that a candlestick can form. What does this mean? This means that there's only 6 ways that a 1-minute candlestick can form. There's only 6 ways that a daily candlestick can form. There's only 6 ways that a monthly, weekly, yearly, etc. can form. 6 different ways, but 3 main ways. So we have 6 different categories here. However, as you can tell, 2 are within 1, right? So we have a classic sell candle, classic buy candle. These are both classic candles, expansion candles, right? These are classified as distribution candles, expansion candles. Where are these candles on the right side of your screen here? So think of it. These are pairs of 2. Pairs of 2. Pause the video, take a guess. What is the classic sell candle? What is the classic buy candle? Pause your video. All right, the answer is, and those of you who didn't pause the video, this is your loss. This right here is the classic buy candle. And this right here is the classic sell candle. Both distributing candles. Large ranges. Expansion downwards. Disrespecting PD arrays along the way. All right? Next, we have a buy candle range. What does this mean? What's a buy candle range and what is a sell candle range? Pointed out on the right side of the screen. The answer are these ones. This is a buy candle. This is a sell candle. Now, why are they called sell candles and buy candles? They are called sell candles because they close lower than the open. They are called buy candles because they close above the open. Now it's called a range. Why? Because price manipulated lows and manipulated highs came back near and around the open. Same thing with the buy candle range. We have price opening, likely manipulating lower, taking out some PDRAs, rejecting a low, manipulating higher, rejecting PDRAs, finally rejecting a high, and finally coming back down near and around the open. This is a ranging candle, right? So we have a classic candle, expansion candle. We have a classic ranging candle. And next, we have a classic reversal candle. So we have the bearish reversal candle or the bullish reversal candle, as you guys can guess, are these two right here. How is this a bullish reversal candle? Price opens right here, manipulates to the downside, likely hitting a key level, reverses, probably coming back down into an order block, and pumping all the way back up, forming a high and closing. All right, so that is a reversal where we manipulate to the downside and we expand upwards. We reverse at the downside. It's the opposite for the bearish scenario. Price opens, manipulates a high, likely hitting a key level, and then heading lower, expanding downwards. All right. Understanding the above is very important because we can apply them to any single candle on your chart. I am repeating this once again. A daily, weekly, 4-hour, and even down to a 1-minute chart. These candlesticks will be found everywhere. Okay? Within each of the above candles, we have different phases called profiles. This means that within every single candle on your chart, there is a lower time frame available. Within those lower time frames, you will find different phases called profiles. So this is basically breaking down the power of 3. Profiles are to help you understand the power of 3. Okay? That means that within a weekly candle, you can go down to a lower time frame, look at market profiles, and determine what your weekly bias and narrative will be. Right? Firstly, we have the open high low close and the open low high close, both of which are very, very important. Okay, this needs to be a picture that is ingrained into your heads. How candlesticks form. How does the higher time frame candlestick actually form? All right, diving into the weekly candle. There are 3 main ways that a weekly candle can form, right? Going back to the last slide, 6 different ways, right? 1, 2, 3, 4, 5, 6. But 3 different categories. We have the expansion, classic candle. We have the reversal, and we have the range. All right. So all of the each of the 3 main ways that a weekly candle forms represents one of these ways. Okay. So all of the 3 ways that a weekly candle can form are a combination of different market profiles. In order to anticipate the weekly candle formation, you must put your focus on key levels, PDRAs, and dealing expansion ranges, etc., as these work together with the market profiles that form the weekly candle. Right here to the right, we have a weekly candle. We have the open, the low, the high, and the close. On the lower time frame right here, you can see exactly what went on during this specific week. So price opened up at this level. All right. Price opens, manipulates a low. What low? Turtle soup. Manipulates a low below the open and expands upwards, right? Within this candle, so we manipulate a low, we expand upwards. Within this candle, there was a retracement. We have a retracement. These are all market profiles within the specific candle, right? After the retracement, we continue expanding towards the high, creating a high, and then we reverse lower, ranging near the highs. Reverse lower, ranging near the highs, and finally close. That's exactly how a weekly candle will form. Within this range, we have different profiles. We have a profile right here. We have a profile right here. We have a profile right here, and so on and so forth. The market profiles that we learned about in the previous chapters are based solely on price. That means that when we look for a range, that is solely based on price. When we are looking at manipulation, that is solely based on price. Expansion, price, etc. The weekly profiles, on the other hand, are based on time and price. What does this mean? A weekly candle will form based upon price and time coming first, right? This means that if on a specific day of the week a PD array is hit, then something else is supposed to happen next. This means that there is a time function within the formula. Right? The goal is to divide the weekly candle into separate phases to get a deeper understanding of the profiles themselves. Let's get diving deeper. The three different weekly profiles will allow you to anticipate the open, high, low, and close, or the open, low, high, and close of the weekly candle. Using a weekly profile will help you find the higher time frame bias and narrative. Finding a weekly draw on liquidity will become much easier with the understanding of these three weekly profiles. Validating the anticipation of the weekly profile comes down to using the appropriate tools. What are these tools? Key levels, market profiles, PD arrays, dealing ranges, expansion ranges, etc. Right? Keep in mind, these market profiles are coming from the lower time frame. There are multiple lower time frame market profiles within one weekly candle profile. So on the other slide, when I mentioned the lower time frame market profiles are solely based on price, the ones that we learned in the previous chapters, I was saying that for a reason. There are multiple lower time frame market profiles within one weekly candle profile. All right. Key factors here to consider. Right, so these are key factors to determining the correct weekly candle profile formation. Use the Monday candle and its price action to anticipate the formation of the weekly candle. Monday's candle will provide you with enough knowledge and information so that you can at least anticipate the next profile. What does this mean? This means that Monday's price action should give you enough information on the chart to help you anticipate what are the next lower time frame profiles to play out next. The weekly candle profiles are variable in nature. They are dynamic, right? So they change a lot, frequently, often. This means that the profiles can change in the middle of the week depending on the key levels and draws on liquidity. So sometimes we can have a key level hit on Wednesday, or better yet, a key level hit on Thursday, creating a high of the week on Thursday, and then a low of the week on Friday. These are not the best of conditions, however, they do happen. What is the general formation of a candle? Tuesday, high of week, Thursday, low of week, Friday, within range, Monday, within range. Okay? So the 3 weekly candle profiles. There's 3 of them, all of which are based on the 6 different candle formations that we talked about. The 3 main weekly candle formations are, first off, the classic expansion candle that we spoke about. So we have the buy and sell candle, both of which are within this category. The second would be a reversal candle. So this was the third candle category that we spoke about. Wednesday reversal candle, power of 3, classic. And of course, last but not least, a ranging candle. Range that leads to eventually a reversal. In total, there are 6 different ways or profiles that a weekly candle can form. However, those 6 profiles can be simplified into 3, as half are bullish and half are bearish. Alright guys, so here we have a classic expansion candle. Formation possibility number 1, where Monday creates a range, Tuesday takes out Monday's low, at a higher time frame daily or weekly key level, likely in a discount. So right here you can see Monday. Let's take out the highlighter here. We can see Monday creating a range, Tuesday hitting a key level, manipulating past Monday's lows, likely in a discount market. Wednesday's candle does what? Expands to the upside. Right? This is expansion towards the draw on liquidity. What's the draw on liquidity? An opposing key level in the form of a PD array. Remember, the market goes from internal range liquidity, IRL, to ERL. Back to IRL, back to ERL, back to IRL, back to ERL. And this goes back and forth. Okay? What is this? Internal range liquidity and external range liquidity. What's internal range? What's external range? This is external range liquidity. This is internal range liquidity. Let's say this is a fair value gap. This would be internal range for value gaps within a range. This is external range above a high or below a low. Okay? Very, very straightforward. Now, looking at this price action, we can let's just erase this. We can see Friday has a slight retracement back into the range, and Thursday created the high of week, while Tuesday creates the low of week. Sometimes the drawn liquidity is only reached on Friday. Okay, so instead of the drawn liquidity being hit on Thursday, it would only be hit on Friday. How would you notice this? Look at the key level. If it's not been hit on Thursday, it's likely going to be hit on Friday. Let's look at this exact setup on the lower time frame. So right here, dropping down time frames, you can see we have a range on Monday. We manipulate lows on Tuesday. And we expand on Wednesday and continue the expansion on Thursday. While Friday, we see a retracement downwards. All of these are ranges, profiles in specific. So let's just remove all that. We have a market profile over here, a market profile over here, a market profile here, another one here, and another one here. Do you recognize a pattern? Every single daily candle has a market profile attached to it. We have a range. We have manipulation. We have an expansion. We have continuation of that expansion. And then we have a retracement. Right? Now, to get deeper within each daily candle, within each daily profile, there are lower time frame profiles as well. These profiles can all be viewed on a 4-hour time frame. Okay? This, of course, is one of the highest probability weekly candles to form. A classic expansion candle. I forgot to mention that there are two possible ways that a classic expansion can form. One of which being Monday range, Tuesday taking out the low or high of week, hitting a key level likely in a discount market, then expanding higher on Wednesday, no retracement on Wednesday, only an expansion profile, no protraction retracement profile, Thursday expanding, tapping into the highs, and Friday retracing. Of course, Friday can also be the draw on liquidity. Now, the second option would be a retracement on Wednesday. So, this would be the classic expansion candle number 2. Instead of Tuesdays being the high or low of the week, Monday tests the higher time frame key level and therefore created the low of the week. This is why we must wait for Monday's candle to form in order to anticipate the full weekly profile. During Wednesday's candle in specific, we have a retracement before expanding again towards the draw on liquidity. Okay, so instead of a manipulation event happening on Tuesday taking out Monday's range low, like the first expansion candle, we hit the key level on Monday and expand on Tuesday. A retracement occurs on Wednesday and the expansion continues all the way through Tuesday, likely into the New York Open, tapping the opposing end of the range and retracing on Friday. What does this look like on the lower time frame? So right here you can see Monday tests the key level and then expansion profiles come next with a retracement as well on Wednesday. So we have a reversal profile or a manipulation on Monday. Tuesday begins to expand upwards. Expansion. Wednesday retraces downwards. We have a retracement profile. And Tuesday expands towards the draw on liquidity. Friday, of course, is a retracement profile as well. Right? Of course, if Thursday was not simply listen, okay, so let's get deeper. If Thursday's price action expands into a key level, and when I mean expand, we close into the key level and then we come down, seeing a change in state of delivery, it's likely that it's likely that Friday is not simply a retracement to continue upwards. Friday will be a complete reversal of the market, heading towards at least the midpoint of the weekly range. That is a model in itself. I'm not going to talk much more on that. So very, very straightforward here. Hitting a key level, expanding, retracing, expanding. Okay, let's move on to the next candle formation. This right here is a classic reversal candle. We call this the Wednesday reversal. Why? Because the reversal likely happens on Wednesday when the opposing end of a daily range has been hit, as well as a key level. All right, so Monday we have a small expansion. The expansion, of course, is going to be weak because we failed to hit the key level below us. So, if Monday hit the key level, we would have seen a profile like we saw the other time. Retracement on Wednesday, expansion towards the DOL on Thursday, and a reversal. Okay? Since the key level was not hit on Monday as we expanded lower, we now know that Tuesday will not expand up and will likely push lower towards the key level. All right? Tuesday's candle will usually be an inside bar, leading Wednesday's candle to reverse and turtle soup Monday's CRT range. The soup must test a key level. Price then expands to the opposing end of the range on Friday and tests the draw of liquidity. Every single month, week, day, every single candle has a function and a role, starting with a key level being tested and ending with an opposing key level being hit, right? So for example, Monday expands lower. We create a high and low. Tuesday forms an inside bar. We close within Monday's candle, inside bar, high and low. Wednesday will manipulate Monday's lows, Monday's CRT low, hitting a key level and reversing upwards towards the draw on liquidity. First off, we have the lower time frame draw of liquidity, which is Monday's CRT high, and of course the weekly draw on liquidity, which would be the opposing key level of the weekly profile. So looking at the lower time frame, we can clearly see that Monday has an expansion candle. We form a high and a low on Monday. Tuesday forms an inside bar, right? So this is Tuesday's daily candle. Inside bar ranging. If we are ranging above a key level, what is likely to follow through? This is from the previous chapters. What follows a range above a key level? A manipulation into the key level. That means that Wednesday will manipulate below Monday's lows, below Monday's CRT, and hitting a key level. Then we see an immediate expansion upwards. This is exactly how to catch the weekly expansion. You must wait for a key level to be hit and then a lower time frame confirmation in the form of a change in state of delivery or a market structure shift. Then you would position yourself to exploit the weekly expansion towards the opposing higher time frame key level. In this situation, we would wait for the Wednesday candle to test the higher time frame key level and form a 4-hour CRT before entering long. So this is a weekly candle. We have Monday's daily candle, Tuesday's daily candle, Wednesday's daily candle. Within Wednesday's daily candle, as we're tapping the key level, we want to see a 4-hour CRT that we are entering on and targeting the opposing end of the range. Very simple. So what are the profiles here? We have a range on Tuesday. We have an expansion on Monday, but a weak expansion. So a weak expansion. Weak expansion. Why is this considered a weak expansion? Because we failed to hit a key level. Weak expansion, range inside bar, manipulation on Wednesday, expansion on Thursday, and continuation of the expansion on Friday towards the draw on liquidity, the opposing end, the opposite key level. Last but not least, we have the range candle. So the range leads to a reversal, and this is one of the profiles that I mentioned at the very beginning, where Thursday creates a low or high of the week and Friday forms the opposing end of the week. This is dubbed a seek and destroy profile from ICT. Okay, I'm sure a lot of you guys know about this one. Does not happen often, but when it does, a lot of people on Twitter start crying about their losses. So firstly, we start with a Monday expansion. This is a weak expansion due to the fact that we have not yet hit a key level. Right? You can see right here, Monday never hit a key level. On Tuesday, price forms an inside bar. Wednesday's candle takes out Monday's CRT high and starts to expand lower. On Thursday, we hit the higher time frame key level. It's finally tested, and so price decides to reverse up and finally end up drawing towards the opposing draw on liquidity. Of course, that would be hit on Friday. Weeks like this can form when Thursday has high impact news and the key level was not yet hit. So let's just look at this picture a bit more. We can see Monday forming a range high and low. Tuesday forms an inside bar, once again ranging. Wednesday takes out the CRT high of Monday. We have not yet hit a key level on Monday, Tuesday, or Wednesday, but we have taken out a CRT high. We reverse at Monday's CRT high, and on Thursday we hit Monday's CRT low as well as a key level. So a CRT low plus a key level, high probability conditions, locate a 4-hour setup, go long targeting the opposing end, which would be the key level on the higher time frame. All right, so we have different market profiles right here. Let's move on. All right, so just to add some more details here. On Monday's candle, we form a range, right? So how do we form a range? Monday's candle expands upwards without hitting a key level. So price comes down, fails to hit the key level, and expands upwards, creating Monday's low and high. Tuesday forms an inside bar. Tuesday ranges. Wednesday takes out Monday's range high and starts to head lower. Thursday expands towards Monday's low, CRT low, and hits a key level. And then Thursday starts to expand upwards, and Friday expands towards the drawn liquidity of the week. So Monday we have an expansion, but this is a weak expansion due to the fact that we have yet to hit a key level. Forms a CRT high and low. Tuesday is a range. Wednesday, manipulation, and then expansion. Expansion towards Monday's CRT low and a key level. Of course, Thursday forms a reversal, classic reversal candle, right? Range to reversal. And Thursday expands up with the reversal. Friday continues the expansion. So this entire price action right here is a range above a key level. This is the key level. Finally, Thursday manipulates, hits the key level, right? After a range above a key level, we manipulate into the key level and we expand off of the key level to an opposing drawn liquidity. All right, guys, that is it. I think you learned enough about the weekly profiles, about how weekly candles form. Very important thing to remember every time you hop on your chart. To look for a weekly profile, you must mark out your daily key levels, the higher time frame daily key levels. So hop onto a daily time frame and locate key levels. With that being said, I'm looking forward to actually recording chapter 9. It's going to be an interesting one involving the charts. So for those of you who don't like PowerPoints, chart work is on the horizon. Have a nice one.